Good morning and welcome to the Heritage Foundation and our Lewis Lehrman Auditorium. We, of course, welcome those who join us on our heritage.org website on all of these occasions, those who are also joining us on the C-SPAN network. For those in-house, we would ask that courtesy check that our mobile devices have been silenced or turned off. For those watching online, you're welcome to send questions or comments at any time, simply emailing speaker@heritage.org. And we, of course, post our program on the Heritage homepage following today's presentations. Leading our discussion is Norbert Michel. Dr. Michel is Senior Research Fellow in Financial Regulations and Monetary Policy in our Thomas A. Rowe Institute for Economic Freedom, Dr. Michel studies and writes about financial markets, monetary policy, reform of Fannie Mae and Freddie Mac, also focuses on the best way to address difficulties in large financial companies under the rubric of the too big to fail problem. He joined Heritage in 2013. He was a tenured professor at Nicholls State University's College of Business, teaching finance, economics, and statistics. He had previously served here at Heritage as our tax policy analyst in our Center for Data Analysis, and he holds a doctorate degree in financial economics from the University of New Orleans. Please join me in welcoming Norbert Michel. Norbert.
Thank you, John. And joining me here today, I'm going to do a short version in the interest of time, a short version of our bios. Joining me from the far left, my far left, is my colleague David Burton, who is a senior fellow in economic policy here at Heritage. And next to him is Paul Mirsky, who's the Group Executive Vice President of Congressional Relations and Strategy at the ICBA, Independent Community Bankers Association. And then Aaron Klein, last but not least, who is a fellow in economic studies and the director of the Center on Regulation and Markets at the Brookings Institution. Thank you all for coming today. We are, of course, talking about the Senate bill that is moving probably this week. So it looks like we had really good timing. It's brilliantly planned, of course, not luck. And I'm going to just do a quick overview of some of the highlights, some of the main components that are in the bill, a couple of the minor things that are in the bill, and then we'll get our discussion going off of that. So one of the main things that is in the Senate bill is what is called a community bank leverage ratio, something that the Senate does not like to call an off-ramp. So we'll call it a community bank leverage ratio in deference to the Senate. This measure would provide relief from the Basel risk weights for banks that are under $10 billion in total assets, maybe. And I'll get to that in 1 second. The bill stipulates that the federal banking regulators will put the actual ratio together, but it does specify that it has to be tangible equity to total assets, and it has to be somewhere between 8 and 10%. So there's some regulatory discretion there, but it is a little bit boxed in, a little bit predefined. However, if a bank meets this leverage ratio, a bank that's under 10 billion in assets meets this leverage ratio, and the regulators determine that their risk profile is not okay, then they do not qualify for relief even if they meet the ratio. And that risk profile is based on things like off-balance sheet exposures, derivative exposures, and trading assets and liabilities, as well as other factors that the regulators might come up with. So that's one of the main components. Another is what we commonly call the SIFI threshold. This measure would provide relief from the heightened capital standards that came from Section 165 of Dodd-Frank. It raises the threshold from 50 billion to 250 billion, but not really. It raises that threshold, and it still allows any prudential standard to apply to a bank holding company with 100 billion in assets. And then on top of that, it still gives the Federal Reserve the authority to tailor regulations to any bank holding company below $100 billion. So this is sort of, we kind of are moving the ratio, but we're kind of not, I think. That's how I'm taking this anyway. Because they're really not just hard and fast moving the ratio. They're not. Another major component is the ability, some relief from the ability to repay or QM standard. If a bank less than 10 less than 10 billion in assets that agrees to hold the mortgage on their books and as opposed to securitizing it, then they get a QM safe harbor. That is a potentially large one, and it's probably from estimates that we've done, I think it probably impacts about 25% of the mortgage market. A lot of community banks don't hold, but a lot of them do, and it looks like around a quarter of the market. Stress test relief, I'm sorry. I need stress relief, as you can see. Stress test relief, the Senate bill would decrease the mandatory scenarios that have to be reported from 3 to 2, and then it would change the frequency of company-run stress tests for banks that are over $250 billion from annual to periodic. And Jerome Powell testified that, yes, they would in fact still be doing this, but I don't think that anybody really knows exactly what periodic means, but it's not annual. And then there's also a component that does the same thing for banks that are over 10 billion in assets for the company-run stress tests. And then there's also Volcker rule relief. The exemption would be for banks less than 10 billion in assets and trading assets and liabilities that do not exceed 5% of total assets. So it's not a blanket exemption from Volcker, but it is a pretty wide-ranging exemption for Volcker. All of those are the ones that I consider to be the main components, and you'll notice that the $10 billion in asset threshold is in there for most of those. That's actually most banks. Most commercial banks, by far, number of around 5,000, and we're only talking about a number above that that's in the hundreds. So it is something. It is better than nothing, I think. That's kind of the way I look at part of this stuff anyway. And then there are a bunch of minor provisions in there. A lot of them overlap with things that have been passed in the House, either through the Choice Act or through separate bills. Some of the minor ones, just really quickly, shorten call reports for banks with less than $5 billion in assets, shorten call reports in the first and third quarter. There's another provision on the cap market side that provides regulatory parity for national exchanges. It extends the blue sky law preemption for securities on all stock exchanges instead of just the New York Stock Exchange and the Amex. There's a reciprocal deposit bill, which I'll talk about in another segment of what we're going to do here, which would no longer, or would ensure that reciprocal deposits could no longer be defined as brokered deposits if the amount used does not exceed the lesser of 10 billion or 20% in liabilities. There's a provision in that changes the liquidity coverage ratio. It includes general obligation municipals as well as certain municipal revenue bonds as level 2B to letter B, high quality liquid assets. And then the last one, it would change the bank exam frequency again for a few banks. In 2015, this was done for banks with under $1 billion in assets, and they put them on an 18-month cycle. This would raise the threshold to about $3 billion, or to $3 billion, which would roughly cover about 400 banks or so. And that's a quick overview of what's in the bill in my minor and major categories. And I also have out front, if you didn't see on the way in, on your way out, there is an issue brief with a handy chart, and it lists almost every one of the components that are in there and does a comparison to some of the stuff that's in the House. So that's that segment. And what I would like to do next is just go to Aaron and say, Aaron, what are some of the things that you particularly like or don't like in the bill?
Thank you, Michael. Thank you, and thank you for having me here. I think it's fantastic that you've assembled a group of people to have a discussion on this bill that's before the Senate floor, and as you outlined very well, there's a lot of stuff in it. It's a big deal bill, and on a broad level, I would say it covers a lot more than just targeted relief for community banks, as some of its supporters kind of put it under. And it does a lot less than gut Dodd-Frank, which many of its opponents say it does. The truth falls somewhere in between. I'm going to list out 3 things I like and 3 things I don't like in this legislation, kind of picking off the menu that you laid out. I want to start with one thing I like, which is this is how a bill kind of is supposed to happen as we learned in school. And this process is very different from the process that's unfortunately dominated what little legislation has gone through, which is kind of closed door leadership meetings with kind of cake. The cake is baked and it's put forward. The process that went through here, the chairman of the committee and the lead Democrat or ranking member put out a call for all ideas together. They held multiple public hearings on this. There was a substantive negotiation. The two of them couldn't reach an agreement. That's fine. Subsequent to that, a group of moderate Democrats could reach an agreement. One can debate the wisdom of Democrats splintering and not having a united front. On the other hand, this is politics. This is the votes. Correspondingly, the package has more than the 60 votes necessary to overcome a filibuster. It moved out of committee after a very lengthy markup with over 40 amendments debated, called. That's great. Have open conversation, have a robust dialogue, put out ideas. One of the biggest mistakes in the Dodd-Frank process, in my opinion, was when Republicans filed 400 amendments and offered 0 at the committee markup. It was a 20-minute markup, not because everybody wasn't there to have debate, but when you have a committee markup, the chair says, who has an amendment? And if nobody brings an amendment, there was a strategy to just not debate. Democrats put forward alternatives to parts of the bill they didn't like. There was a debate, there was a vote. I look forward to a robust debate on the Senate floor. Maybe the package holds, maybe it doesn't. This is the process. It's nice to be back to bipartisanship and to have an open process. So I thought that was kind of point one. Point two that I like, you mentioned it, it's section 403 of the bill. It involves municipal assets and muni debt. Let me just take a giant step back. Banks fail because of a lack of capital. Banks can also fail, particularly investment banks. We use the term bank a little too loosely in our nomenclature, because of lack of liquidity or perceived lack of liquidity, the classic run on a bank. Whether a bank is solvent or not at a time of crisis is hard to know. Liquidity being a problem, the regulators said we're going to have liquidity coverage ratios and require banks to hold high-quality liquid assets. Now, something very funny happened. I don't know if you caught it. The problem is not having enough liquidity. The solution became high-quality liquid assets. Having an asset of quote-unquote high quality and having a liquid asset are not necessarily the same thing. But in regulators' minds, particularly as this was an international rule and started internationally, the two became synonymous. In the corporate debt, in the government security space, high quality and liquid have a fair amount of synonymous. That relationship breaks down in municipal debt. Let me give you an example. If you own a small county's water system, you can have a very high quality asset, but it's very illiquid. It infrequently trades. On the other hand, of the top 6 municipal debts that traded last year, 3 were Puerto Rican. That's not a high quality asset, but it's highly liquid. What ended up happening where the regulators said, well, God, this muni thing, this is really complicated. There's no international comparison. We'll just kind of ignore it. Well, that's a problem because corporate debt got treated. So now you've preference from a regulatory perspective, one asset class over another. In addition, and then subsequently the Federal Reserve appreciated that there are high quality liquid muni assets, or put a different way, they're municipal assets of high quality that in times of crisis probably could be sold, whether that requires a decent haircut for selling or not, as long as the haircut doesn't change during the crisis. And the Federal Reserve moved a little bit. The other bank regulators did not. There's a lot of uncertainty in this. I'm generally skeptical when Congress weighs in at a regulation at this level to say this asset class qualifies at this level. But when you get into the substance, it's the right move. This is a very high haircut. Ironically, if you go back in time and reran this test, Enron debt would have qualified as high quality and liquid asset well into 2002. But the state of New York or New York revenue bonds dedicated by separate revenue might not have. So Congress is wise to put municipalities on parity with corporate debt here. The third thing I like is Section 401, which raises the SIFI threshold. And I want to get back to not the debate about what number it should be, but to understand why 50 billion should be changed, you have to understand what the logic was when we put 50 billion in Dodd-Frank, and you have to go back to a 2009-10 mindset. It's a very different mindset. When the concept was being structured that there'd be a set of banks subject to enhanced prudential standards, stronger regulation, now called SIFI banks, the concept at the time was, well, we were really concerned that this would be giving the government imprimatur that these banks were too big to fail. And it would actually be an advantage to be one of these banks. And policymakers were concerned that markets would interpret that if you were a SIFI bank, the government stood behind you. This is in 2009, where it wasn't clear which banks were stable or not. So we said, what's one way to get around this moral hazard argument? Well, let's set the line so low that it's clear that if one of these smaller banks failed, the government wouldn't step in and provide extraordinary assistance. So the market wouldn't really know where this extraordinary assistance line was. And that was the dominant rationale for setting a $50 billion limit. A decade later, a couple things have become clear. One is the concerns about moral hazard are no longer as valid and may have been overstated at the time. Research has shown there's no benefit to this being over 50 billion. There's, in fact, more regulatory cost. There's no rush among financial institutions to grow over the $50 billion threshold in the market. And it's time to re-examine that. In addition, the number was hardwired. It doesn't grow with inflation, doesn't grow with assets, doesn't grow with the economy, so it actually, in real terms, shrinks over time. And as Dr. Norbert said, there's a catch-all that the Federal Reserve has authority if they see a bank engaged in risky activities or throughout the correlated set of institutions engaged, they can still apply enhanced prudential standards. So it's not a complete walk away. That doesn't necessarily mean I think the statute's exactly right as written. The Federal Reserve's authority may be hemmed in a little bit. Reasonable people can argue whether 250 is the right line or whether or not to have a hard line at all. Right now, as it's written, at 249, the Fed could decide not to provide enhanced prudential standards. You grow to 251, and all of a sudden you're in. Has your systemic risk profile really changed? Three things I don't like. One, there should be something in here for consumers. We've seen multiple major scandals within the financial services industry. What Equifax has happened in terms of data breach has exposed not just problems there, but within the underlying economics of credit reporting. 1 out of 4 people have an error on their credit report. There are many Aaron Kleins out there, not all of whom pay their debts. Try getting your credit report fixed. There's no legal requirement that there be any accuracy in your credit report, beyond which the system and the economics within credit reporting don't favor fixing it. There should be something in there to address this. There should be something in here to address some of the problems uncovered in the Wells Fargo scandal. Other major deregulation bills have included new consumer ideas. The Community Development Financial Institutions Act was passed as part of the Regal-Neal Act to help provide access to low-income communities. We could use more access to new businesses, more access to credit for new businesses. Coupled with that, it would be nice if this were the end. One of the things I like about this bill is that it accepts the framework of Dodd-Frank and tries to modify it. One of the things I don't like is that I don't feel an acceptance that a modified framework is enough to put this issue to bed and move on. We can't constantly be relitigating the response to the last financial crisis. We have to put in place a new framework and see how it goes. Acting CFPB Director Mulvaney last week called this a beachhead. From my perspective, this is the end of the set of changes, not the beginning. The second thing I don't like is Section 402. This is the treatment of custodial assets that Michael referred to. Let me just, without getting overly complex, there's current bank regulation has 2 binding constraints, a simple leverage ratio and a risk-weighted asset ratio. I like them both. I call it the chopsticks approach to financial regulation. With 2 chopsticks, you can eat anything elegantly. With 1, you're stabbing at it. So I don't like either one simple leverage ratio or just using risk weighted. But the thing about the simple leverage ratio is it's simple. What this section does is it takes one activity and says, this is so safe, we don't need it to be part of the simple leverage ratio. Okay, maybe. If you really believe that, then do it for the entire activity. But what this section of the bill does is it exempts only 3 institutions who do custodial assets and not the other 30. So what you're having is government picking winners and losers within an activity that will cluster that activity within those 3 institutions. Clustering a systemically important activity, like custodial assets, within a smaller number of institutions increases systemic risk. That's not the goal of the bill. So I think there are 2 logical places to go to fix that. One is eliminate it and keep the simple leverage ratio simple. That's my preference. 2 is if policymakers want to kick this out of the ratio, kick it out for everyone. We're kind of ended up at the worst of both possible outcomes. And the last problem I have with the bill is the removal of the disclosure for about 4,000 financial institutions to report data that's been reported for years on racial information on home mortgages. It's called the HMDA data from the Home Mortgage Disclosure Act. You know, look, it's a horrible thing to say, but it's true. There's still racism in society. There's still the legacy of redlining, of which the federal government bears a lot of fault for promoting racial discrimination in lending, but so does the private market. Collecting data is one of the most powerful tools we have. I would hope people in the free market perspective would prefer data collection as opposed to government regulation, and let the data speak. This bill exempts about 85% of banks from reporting data they've reported for years on racial discrimination. I think that's just A, bad policy. B, I'm concerned that by just leaving us with data reported by the big banks, we're going to draw some of the wrong conclusions. And I don't know which way about racial disparities in lending. I'll close by saying one of the reasons I'm a big supporter of America's small bank network, which I think should be a comparative advantage for our economy, is that it allows banks to provide credit to people who don't fit this giant credit commoditized bucket that we've moved into more and more as technology's allowed commoditization and securitization of credit to occur more easily. Small banks know their community and can make these loans to people that go, you know what, for whatever reason you don't fit this big box. Perhaps it's because there's something wrong on your credit report, but we're going to provide you credit. That's fantastic. That provides a new value of opportunity. That should work sympathetically with also providing information about the type of folks, because I would guess that's one of our best tools to combat discrimination in lending. So I wish that would be changed in this bill. Those are my thoughts. Thank you very much for having me.
Thank you, Aaron, and thank you for the segue. Speaking of small banks.
Well, great. I'm glad to be here. I'm very excited about the bill being on the Senate floor this week. The best thing about this bill is that it's a bill that can pass the Senate and pass with 60-plus votes. We've seen very few bills that attract this kind of bipartisan support. The vast majority of banks in this country are community banks. There's about 5,700 banks in the country right now, commercial banks. And if you shave off the top 15, 20 banks, the largest ones being in the trillions of dollars, most communities are served by a community bank. This bill is targeted at those banks. The vast majority of provisions in this bill are targeted at community banks. And let me just say from the beginning, we're not looking at regulatory relief for the sake of changing some regulations. There's a broader purpose for this legislation. The purpose is not tweaking a few regulations or changing a asset threshold on very complex regulations. The key point of this bill, and in the title of this bill, is economic growth. What we've seen with Dodd-Frank applied a very heavy hand of regulations across the board for banks that are trillion-dollar banks to banks that are $50 million banks. What this bill is attempting to do is right-size a lot of those regulations so our community banks around the nation can do what they do best, and that's lend in their local markets. Since Dodd-Frank passed, we had many of our banks drop out of the mortgage business because it was too complex, too many rules. So a lot of the rules in this bill that are being changed are addressing the mortgage lending space. So keep those community banks in mortgage lending. If you're only doing 50 or 100 mortgages a year as a community bank, and you have to do tens of thousands of dollars of new regulations, you're going to reassess and maybe drop out of that business, which kind of defeats the whole purpose of Dodd-Frank, was to rein in the largest banks and control systemic risk. If you have more small community banks leaving the marketplace and scaling up, then you're left with only a handful of banks at the end of the day, and you have greater systemic risk. So one of the things I like about this bill is reducing the regulations on community banks so they can stay viable in the marketplace and extend credit, which is really the lifeblood of many communities. There are thousands of counties around the country where the only physical presence bank is a community bank. I like that bill for that reason, not because we want to tweak regulations. It's really about economic growth and being able to serve more consumers. I want to correct one thing on the HMDA data. The bill is only addressing new HMDA reporting. In Dodd-Frank, Dodd-Frank in the statute of the legislation put in about 5 or 6 new data fields that would have to be collected under HMDA. The CFPB took that and added about 20 more to it. So what the legislation is doing is all the existing HMDA reporting on mortgages is there, so there's not going to be any new discrimination or anything as claimed. What it's addressing is new data that would have to be collected in addition to what Dodd-Frank put in and CFPB put on top of that. So it was overkill on new data reporting. And look, banks don't want to spend their entire day collecting and reporting data that then turns around and is used against them if they miss a comma or have something inaccurate in their mortgage documentations. Then they're attacked for that. So we don't need all this new reporting data. And even with the new HMDA exemption here, 97% of all mortgages will be covered by the HMDA reporting. So we're not too concerned about that. What we really are concerned about is keeping community banks, small banks in the marketplace so you don't have the concentration in just a handful of banks doing mortgages, as we've seen. I'll stop there, and we could talk further about other provisions in there.
Thank you, Paul. Sort of going along in the same spirit, but a little bit of a switch up. One of the things that we're hearing a lot in the background is that there's room to do some capital markets changes. And that's why my colleague David Burton is with us. David?
Norbert asked me to talk about some things that should be in the bill that aren't in the bill. And I have identified 9 items, all of which would improve the regulatory environment for entrepreneurs seeking to raise capital. 7 of them have passed the House on a bipartisan basis, in some cases unanimously or nearly so, and then 2 others. So let me just quickly run through the 9 items that should be included in this bill and really shouldn't be that controversial and should be able to achieve bipartisan consensus. Congressman Schweikert introduced legislation relating to accredited investors, H.R. 1585, which passed the House November 1st by voice vote. What it would do would be to set the monetary thresholds for determining who is and is not an accredited investor at the current regulatory levels, but by statute, and then broaden it in 2 respects. One, brokers, so-called, would, by which he really means registered representatives, people working for brokerage firms, would be able to invest in private placements and then also gives the SEC authority it already has to broaden the definition of accredited investor under Regulation D. Regulation D, for those of you who are not familiar with it, is the safe harbor provided by the SEC back in 1982 that if you meet the tests set forth in Regulation D, your offering will be treated as a private placement. Therefore, you will not have to file a registration statement and go public. Filing a registration statement costs roughly $1.5 million in lawyers and accountants and other fees. So it basically is something that's not available to smaller companies. And also at this point, I believe the latest data shows that Regulation D is how about $1.5 trillion is raised every year in this country. It's actually larger than the public markets in terms of new capital raises. It is the most important way that we raise capital. There is what I would consider a drafting error in the bill that should get fixed. The broker under the securities laws means Merrill Lynch, not the people that work for Merrill Lynch, but they clearly mean to allow the individuals that work for Merrill Lynch to be the ones that can invest in these placements, because almost every broker, if not every broker, would meet the institutional requirements under Reg D anyway. The next is the Small Business Mergers, Acquisitions, Sales, and Brokerage Simplification Act, which is really the business broker bill introduced by Representative Huizam, H.R. 477. It passed the House in December by a close margin, 426 to nothing. Basically, what this bill would do would say that business brokers who basically serve as intermediaries when a dry cleaner sells the entire business to a new buyer, or a local hardware store sells the entire business to a new buyer, doesn't have to register as a broker-dealer and be subject to the same regulatory regime as Merrill Lynch. It obviously has very broad support. It's passed the House this Congress and last Congress. The Senate has never taken it up. It's time the Senate did. The next is Improving Access to Capital Act by Congresswoman, Sinema, H.R. 2864, which passed the House in September by a vote of 403 to 3. Basically, what that bill does is allow registered companies, public companies, to use Regulation A+. The SEC the SEC made a mistake and prohibited that for no good reason. The regulatory disclosure requirements for public companies are much more stringent than Regulation A. So there's nothing lost if you allow the public companies, which have to provide a great deal of information, to use Regulation A to do a raise, which is why it passed with only 3 dissenting votes. The Small Business Capital Formation Enhancement Act, introduced by Congressman Poliquin, H.R. 1312. Again, another very controversial bill that passed the House by a vote of 406 to nothing in May of last year, is one of those sort of good government bills. In 1980, Congress required the SEC to hold an annual conference on small business capital formation. Every year, people from around the country gather and make recommendations to the SEC about how they could improve the regulatory environment. Every year, most of the SEC commissioners come to it and explain how important small business capital formation is. Then they go away for the next 364 days and do nothing. Then they come back at the next one, say how important small business capital formation is, and go away. That's been going on for 35 years. Every once in a while, they do something, but it's fairly rare. Congressman Poliquin's bill is relatively straightforward. It's a procedural type bill. It requires the SEC to actually respond to any recommendation made by this small business forum, which is, depending on the year and the structure of the conference, 10 to 15 recommendations, and explain their views with respect to the recommendation and what they intend to do about the problem identified. The next is the HALO Act, or Helping Angels Lead Our Startups Act. For those of you who are sort of familiar with the entrepreneurial culture in particularly the West Coast, but also some other places, they often hold these forums where angel investors, meaning people who are accredited investors, can invest in these startups. Come, and there might be 50 or 100 in a room. The entrepreneur comes in and makes his 10, 20-minute pitch, and then they move on, and they just cycle through. And under most East Coast interpretations of the securities laws, that would be an illegal general solicitation. Yet it goes on. What the HALO Act basically does is set up a series of criteria allowing angel groups, not-for-profits like universities and so on and so forth, to hold these events and forums. So startup entrepreneurs can make their pitch to potential investors in this environment without going against the general solicitation rules. It's a carve out for the general solicitation rules. It's actually something I think that could be useful and important. It was introduced by Congressman Shabbat, HR 79. It passed the House in January of 2017. The Senate has done nothing on it. It passed the House by a vote of 344 to 73. Again, a bipartisan piece of legislation. Another piece of legislation that passed the House by a vote of 419 to 0 is the Encouraging Public Offerings Act. Congressman Budd, HR 3903. What it does is extend the Jobs Act provisions relating to testing the waters that currently are available only to emerging growth companies, which is a category that by its very nature expires after 5 years, because you can only be an EGC for 5 years, to all issuers. So it would basically allow people to test the waters, meaning discuss an offering with potential investors without making an offer, to get a sense of what they could actually sell the securities for, and then make confidential filings with the SEC before they do their full-blown public offering. And again, that passed 419 to nothing. It seems like it's something the Senate should take up, because it would make it much easier for entrepreneurs to raise capital and accurately price their offerings. Two other bills that, in my judgment, deserve serious consideration is the Micro Offering Safe Harbor Act. Congressman Emmer introduced it. HR 2201, it passed the House in November by a significant margin, but it wasn't virtually unanimous like the other legislation. What that bill does is basically stands for the proposition that extremely small offerings under $500,000, 35 or fewer purchasers, or entirely to people with whom you have a substantive pre-existing relationship, which is a securities term of art that's been around for a long time. You don't have to register and become a public company and spend $1.5 million on lawyers. The original legislation basically said it's A, B, or C. The legislation that was actually passed by the House was A, B, and C, so it's actually an extremely narrow bill in its current formation, because you have to be under 500,000, have fewer than 35 purchasers, and have a substantial pre-existing relationship with all the purchasers, whereas the original legislation, in my judgment, much better, would have been any of those three, not all of those three. So that legislation deserves serious consideration by the Senate. And the last is a piece of legislation, again by Congresswoman Sinema, that has been reported out of the House Financial Services Committee, but not adopted by the entire House. It was reported out just after Thanksgiving. And what it would do would be to extend for 5 years the emerging growth company exemption from Sarbanes-Oxley's internal controls reporting regime under Section 404B. That all sounds highly technical, but that is an extraordinarily expensive aspect of being a public company, and in the small firm context really is just a waste of money to the enrichment of the accounting profession. And that's it. But there are a lot of things that the Senate could do that have extremely broad bipartisan support and could improve the regulatory environment for small startup companies seeking to raise capital or small companies seeking to go public. And the Senate really should take these things up.
Thank you, David. Just for the little bit of perspective, there's a pretty much a delicate balance right now with the Senate's, I guess we'd call it bipartisan agreement. But everything that everybody that I know of has been talking about is that if there is something with overwhelming support, that is the sort of thing that they could add to the bill. So that's why it's very important especially on the things that David's talking about. These are things that have passed the House unanimously or voice vote, things like that. They're very much open to doing things that are not controversial because of that. So that this bill probably is going to pass, and it is going to be amended in some way, and those are some of the things that could be in there. So then, before we talk about that process, I'll just get my 3 things in there, my wish list for changes, really fast. One is on the muni provision that Aaron was discussing. Aaron and I see this one a little bit differently, which is fine. My view is that if you're going to have a liquidity coverage ratio, it is about liquid assets, as in cash. If you look at the liquidity coverage ratio, it's about cash in and out. Therefore, while Aaron is correct that some of these things might just be fine in the crisis, we really don't know that, but we do know that about cash and probably treasury securities and nothing else. So in my view, if we're talking about cash and just cash, then we should stop there. I think they got it right the first time. I don't think they should go back. That's our little bit different, but that's my view on that one. The second one that I'd like to see changed is on policy is the reciprocal deposit provision. I would like to, if you're going to have a limited exception for reciprocal deposits as not being brokered, okay, if it's very limited, I could get on board or at least be neutral on how that plays out if it's very limited, and I don't think it's limited enough right now. I think that it should be changed so that it's not just a reciprocal deposit. It should be some other third-party type funding arrangements. Something like custodials should be in there. And most importantly, I think that the percentages should be dropped. As it's written, it's 20% of total liabilities, and I don't see any reason why it should be that high. I'd be much more comfortable with something like 10 or 5, and all these numbers are arbitrary, but the point is that it should be limited, and the more limited, the better. And then my last one, and actually, Paul, I'd love to get your thoughts on this one. My last one is I'd like to see the leverage ratio changed, the community bank leverage ratio. There's a lot of regulatory discretion here, and in my view, it would be better to pare some of that back. One way of doing that, I think should garner a good deal of support is to adopt or amend a Tom Honig proposal from 2015. And what you would end up with is essentially a 4-part test. So instead of having it the way we have it now, where the bank could meet the asset threshold, meet the leverage ratio, and still not qualify for regulatory relief, instead, what you would have is if a bank meets the leverage ratio, meets the asset requirements, has 0 trading assets or liabilities or some other de minimis, no positions in derivatives other than interest rates and foreign exchange derivatives, and has a de minimis total notional derivative exposure, maybe $8 billion, because that's one that was used in previous margin rules. But I'm flexible in that. If you meet those 4 parts, if you meet that 4-part test, then you're out. In other words, then you qualify. If not, then the regulator could still have discretion on a risk profile, but then there's a very clear 4-part test that virtually all traditional community banks would easily meet without any other lack of clarity from the regulators. That's my wish list. I don't know.
Right. Well, there's a lot of changes that could be done to the bill, but being at a think tank, we're talking policy, but you also have to consider really the most important thing this week with the bill on the floor is politics, and to get something with 60 votes is a delicate balance. Many of the bills that were introduced since Dodd-Frank to address Dodd-Frank have been, from Republicans or Democrats. Here's a bill that's been carefully crafted and balanced to get 60-plus votes, to have over 13 Democrats supporting the bill, so you get a filibuster-proof majority. There's all kinds of great changes that could be made to the bill. I hope some of them can be included in the final passage. Things like Sarbanes-Oxley, the internal controls, very expensive for banks to do those, and it's kind of double auditing them. Their bank regulators of all kinds are in the banks, making sure all their books are accurate, and then you have the Sarbanes-Oxley law coming in again with the accounting firms and certifying the same thing. It's very expensive. But that all said, we have to look at both the politics of this legislation and the policy, and you have to have a right mix. One thing I'll say on the macro level, this is the first major rollback and reassessment of Dodd-Frank rules. If this doesn't get traction in the Senate and pass in the Senate, I think we'll be in the desert a long time, wandering around saying, hey, why didn't we take something that was very good and could get 60 votes? And if this passes in a bipartisan way, I think it's going to open up negotiations to do even more in the future.
So that's exactly my concern, right? This shouldn't be the first, this should be the deal, right? We fixed the SIFI threshold shouldn't continually be raised. You can't keep continually going back at it.
There's no law that's ever permanent. Look at the
No,
tax code. You keep changing the tax code.
The
When they
tax-
talk about, oh, we're going to make these tax cuts permanent, there's no such thing.
No, well, there are two
So
distinctions. The tax
everything's
code
a moving
process.
target.
The tax code process has been an unmitigated debacle and is exactly why the process followed in this bill was far better. The constant sunsetting of that is budget gimmicks, much like the budget gimmick Congress just is doing with the Federal Reserve surplus in the banking space. Bank regulation, letting politics dominate in bank regulation leads to policy errors that tend to make us all worse off. That's what I'm nervous about this custodial thing. As you point out, the balance seems to, the politically stable solution seems to be just do a carve out for these three because they're the ones who care about this the most. And if you do it for everybody, then you're benefiting big banks, and that's politically challenging. If you do it for no one, then you aren't addressing this core issue. But then your government's picking winners and losers and could end up making the whole system worse off. With regard to the specific section 201, I'm a little nervous about that section because I'm nervous about this philosophy of knocking out risk-based capital. I kind of like both, the chopsticks approach. Where we may find more common ground is a regulatory approach that allows banks to innovate, take risks, and fail. We have 6,000 banks in America. If you had a city that had 6,000 restaurants and you came back in a year and all 6,000 restaurants were still there, that's not the mark of a healthy economy, right? We ought to be in a situation where banks are businesses. They come up with new ideas, they test new ideas, they challenge, they fail. The period in American history with the longest we've ever gone without a bank failure, 2003 to 2006. That was not a period of health in the banking system. We need a regulatory framework that embraces innovation, competition, and is comfortable with failure. And I get nervous about things that remove one of these two thresholds of risk-based capital or simple leverage ratio. But I'm equally nervous with bank regulators who believe it's their job that nobody should fail under their watch.
Now I want to have another event with you and talk about risk-based capital, but we can't do that right now. But I'm encouraged to hear you say that because I agree. I mean, I think that you're exactly right. We don't want to let banks fail, and that's a terrible mistake. So that notwithstanding, before we get to some Q&A, just to keep things moving along, let me just go down and see if anybody has any thoughts on how this process might unfold now in the coming weeks, whether we're going to look at some kind of conference or quasi-conference or manager's package or amendment, or if anybody wants to weigh in.
Sure,
on that.
I'll jump in there. As it's been pointed out, a lot of these bills actually originated in the House and passed with wide margins. A lot of what's included in the Senate Bill 2155 have companion bills that have passed out of the House, whether out of the House Financial Services Committee or even passing the full House. So I think there's a lot of opportunity to have the House quickly take up the Senate bill, maybe some modifications, maybe not. The best news here is that you have a bill, which we haven't seen in a long time, particularly on very complex regulatory relief measures that can attract 60 votes in the Senate. I think the vote will be much stronger. This bill is for community banks and credit unions. Community banks are in every congressional district around the country, has great support. The House, I think, wants to pass something as well, but has always been stymied by the Senate and that 60-vote threshold. I think at the end of the day, even if the House takes just the Senate-passed bill and passes that, we'll be in much better shape than getting nothing at all on rolling back Dodd-Frank.
I'm sort of agnostic on how the whole thing will proceed, but I can say with some degree of confidence that for at least the last two Congresses, well, the way the capital markets bills have usually happened is the House passes them on a bipartisan basis, and then the Senate accedes to an amendment in the conference committee. If there's no floor amendment here, I would hope we have a repeat of that process where these really non-controversial or broadly supported bills are included as part of the final legislation that's reported out of the conference committee.
So it's a little bit unclear, I think, what this process will be on the floor. There's a lot of talk of including new provisions in the so-called manager's package that could be some of the capital market things that have come out of the House. There could be some other ideas. This Equifax issue, I think, resonates broadly, and if Congress is going to only have one crack over 2 years to actually handle financial services, it would be an awful shame if the thing that probably directly impacted more consumers than any other area, and, you know, let's face it, Congress responds to scandals, right? We didn't get Dodd-Frank because Congress sat around thinking about an optimal new bank regulatory structure. We got it because the entire financial services industry blew itself up. And so Congress responds to scandals. I think there'll be something on credit reporting agencies, I would hope. Whether the House passes something different and insists on a full conference, I don't know. I would point out that one of the hallmarks of transparency in legislative processes is the conference by Dodd-Frank. Believe it or not, there was an open conference. It was televised live on C-SPAN. I can't recall another bill that I've ever worked on in my 15 years in Washington that had an open door conference. Usually one of the conference committee between the House and the Senate meets once to vote upon the deal that they'd agreed to. Maybe they meet twice to open the conference and then close it. But this was one in which you could stay up till 3 in the morning watching members cast live votes on complex issues in front of the cameras. I think transparency is very important in financial regulation. It's complicated. The details that we've gone through in this legislation are not easy. Part of our job as public thinkers on this is to explain it for people to make up their own mind. But I hope there's continues to be a transparent process in this bill going forward.
I second that hope. I don't know that, well, my gut feeling is that it's not, but it's not going that way. But we'll find out, I guess. Maybe some of it this week. Well, that concludes our plan segment up here, and we can open up and we have some time to do some question and answers if anybody in the audience wants to ask. Please have our microphone. Just state your name and affiliation, if you would.
Hi, Steve Perkins. I'm an angel investor, but I actually have a slightly different question. And I believe Paul is certainly right that we've got to really consider political reality in this bill. And I think one of the things that the Democrats are going to fight against is eliminating the CFPB. There's got to be something like the CFPB, or they are not going to vote for this, in my opinion. So I wonder, and I know Heritage has certainly recommended eliminating that completely, but what else can there be? There's got to be some provisions in this bill that will address some of the consumer concerns like Equifax. I'm one of those that lost my information in the Equifax data breach. So, you know, I'm concerned about that, and 150 million other people are also. So I'm wondering, how can that kind of consumer issue be built into this bill?
Right. Well, that's a very good point. There's always been consumer laws and consumer protections in the financial services sector. They used to be largely housed at the Federal Reserve. And after Dodd-Frank, they were moved to a whole new agency, the CFPB. And you could debate the structure of the CFPB and how it should be structured. Should it have a single director? What we've advocated for since Dodd-Frank is to have a bipartisan commission run the CFPB. So it's not just one individual that has tremendous authority over consumer regs. I think that could be structured much better there. But there's no elimination of the CFPB in here. As a matter of fact, I think there's a lot of rules and regulations that the CFPB had put in post the financial crisis that are actually hurting and harming consumers. We talked a little bit about mortgage lending. Many of our community bankers have gotten out of the mortgage lending business. They do small volumes in some cases, and the rules and regulations coming out of the CFPB on qualified mortgage and ability to repay is really hurting the consumer. So I think this bill does a little bit to refocus on helping the consumer. And as I said at the beginning, we're not doing this bill. We're not pushing this to reduce regulations on banks. That's nice. That's a great thing. But the macro point of this bill is to have greater economic growth, greater flow of credit, particularly in those communities. We serve 85% of all agricultural loans are done by community banks. Nearly 60% of all small business loans are done by community banks. And we only represent 20% of the industry assets. If you compare us to the $1 trillion, $2 trillion largest Wall Street international banks, we're a small segment of the banking sector overall, but we're very important. So these rules are really about helping the consumer.
So I think as a political reality, one of the deals cut in this legislation was not to directly address the CFPB. And there's almost nothing in this legislation that directly addresses the CFPB in terms of structure, funding, et cetera. However, unfortunately, and this is one of my criticisms, there's going to be something in the Congressional Appropriations Bill that guts the CFPB's independent funding. That's going to not be enacted into law because of the threat of a Democratic filibuster. We're not kind of putting aside and moving on these questions. The Office of the Comptroller of the Currency created a national bank charter under which many of the community banks operate. It was established by one of the great Republican presidents in American history, Abraham Lincoln. It has a single agency director. We seem to have I've not seen many debates about whether we should have a comptroller of the currency, whether there should be a board or not. We've moved on from that, which is a good thing. We shouldn't be debating the Lincoln era approach to bank regulation anymore, today any more than we should have moved on from the Bureau. With regard to the qualified mortgages, which do get touched on this point, as Michael described, within this bill, this is a subset of the rules. Let me be very clear on a couple different things on this. Number one, the CFPB had a very challenging task to write this new qualified mortgage rule within Dodd-Frank. It was given to the Bureau, in part because other regulators, including the Federal Reserve, had authority on subprime mortgages, and they royally messed up. The Bureau, brand new entity, was given a very complex rule and a tight deadline. They met their deadline. They were the only financial regulator to put out all the rules by their statutory deadline, which is often an unrealistic deadline by Congress, but they met all their deadlines. When they put out the qualified mortgage, the rule was widely supported by industry and consumer groups at the time. Some of the biggest critics of that rule were Barney Frank, believe it or not, who said once about the qualified mortgage rule, it was the exemption that swallowed the rule. I'm a little bit more along with the line of Congressman Frank. I'm more concerned about mortgages that fail to meet an ability to repay test. That is, a consumer doesn't have the ability to repay the mortgage on the original terms it was made, than I am about people that weren't given mortgages because maybe they had a good individual case as to why they couldn't meet the ability to repay rule. We can't forget that the problem in 2005, 6, and 7 was not The problems in 2005, 6, and 7 were a financial services industry and an originate to distribute mortgage world that was bonkers, that created a bunch of mortgages that blew up. So imposing some common sense regulation on what types of mortgages you can have is something I'm comfortable with, or put a different way, going back to 2003 and 4 levels of regulatory compliance on mortgage loans would be a huge mistake in my opinion.
Well, I think slightly, I mean, I'm in the ballpark with you on that one, but I think one of the reasons that they got the rule done on time is because they punted. I mean, the GSE, any GSE eligible mortgages off the hook completely. They're not going to change that right now. You want to see how things will blow up quick, you know, and they're not going to do any major change to the CFPB in this piece. You know, practically speaking, that's just not going to happen. Aaron's right. One of the things that we've always pointed out is that one of the main pieces of creating the CFPB was to transfer roughly 20 federal consumer protection statutes to the new agency. From our standpoint, is we didn't need a new government agency to do that. You could have put it at the Federal Trade Commission. That's what they do, consumer protection. So, I mean, something like that seems like a moderate compromise to me, but that's a non-starter right now, for sure. So, I mean, that's just not going to happen. Any major changes right now are not going to happen.
Thomas D. from Capstone. Do you deduce anything for, you know, as this bill potentially moves forward, do you deduce anything for housing finance reform or any other controversial areas of financial services legislation this year?
Out of this one? No, I mean, I don't think housing finance reform happens this year in any way, legislatively, not this year. And then beyond that, I mean, we'll see, but.
So the last big bipartisan banking bill was the Emergency Economic Stabilization Act of 2008, better known by Section 101 of the law, which was the Troubled Asset Relief Program, or TARP. It got 74 votes in the United States Senate. I doubt this bill will get 74 votes. I could be wrong. It'll be north of 60. I think it'll be less than that. What I deduced is that, and you know, by the way, of the 74, of the 25 who opposed, it was kind of split relatively evenly between the parties. What I deduced was that during a time of great crisis, Democrats and Republicans came together and did something tremendously unpopular but economically necessary in stabilizing the economy. That created the fallout from that was such a toxic political environment that the historic response to the financial crisis, which in banking had been generally these deals get cut on big bipartisan numbers, either on a pro-regulation or a deregulation side. Gramm-Leach-Bliley passed 90-10 at the end of the day, one of the big deregulatory bills. FDICIA and FIREA, which were two of the big regulatory responses to the savings and loan crisis, big bipartisan bills. What happened during the financial crisis was different. It fractured our country in a way that we're still dealing with the framework from. Senator Dodd tried to get a bipartisan deal extremely diligently in Dodd-Frank. It didn't happen. We can debate why not. I don't think anybody can question his personal effort in making that happen. He got 3 Republicans at the end of the day. So it wasn't completely partisan, but it's a pretty small number. Maybe this means bipartisanship is back in banking, but I would say that the next area that a bipartisan consensus ought to tackle is our outdated Bank Secrecy Act and anti-money laundering law. I would say if you really want to look at inefficient regulation that's retarding economic growth and hurting consumers, particularly de-risking lower-income consumers from having the option to get a bank account, is the amount of money that many of these small banks are paying on an ongoing forward basis, marginal rate, you know, scrutinizing all the different Aaron Kleins out there and filing tremendous amounts of paperwork on anti-money laundering. I'll just close on that point. The $50 billion threshold was unindexed since 2009. The currency transaction report is unindexed since 1970. At the time, you could buy not one brand new Cadillac, but 2 brand new Cadillacs in cash and not trigger this report. Today, there's not a single new car out there that you could buy in cash and not trigger a currency transaction report.
Well, you made a good point. Banking issues never used to be very partisan. I know the Banking Committee, Senate Banking Committee, House Financial Services Committee, bills would pass on a very, very wide bipartisan bipartisan margin. I think this bill has the potential to be a strong bipartisan vote. Our position is if you're against this bill, you're against community banks, credit unions, and the communities they serve. The overwhelming balance of this bill is focused on the regulations that are harming community banks' ability to serve their customers. I mean, it doesn't do anyone any good if you want to help consumers and you're putting the businesses out of business that serve those consumers and provide credit in their communities. So I'm expecting a very strong bipartisan vote on this. If you vote against this bill, this is a key vote for our industry. If you vote against S2155, it's a vote against community banks.
Anybody else? Any other questions? Oh, up front.
Just one quick statement. James, you get to.
Only questions, James. Only questions.
Jeopardy is always in the form of a question. Abraham Lincoln is not our model for economic policy. Just get that out there. His platform we ran for Congress was pork barrel spending for New Salem, Illinois, and high tariffs. So let's just move that by.
Well, high tariffs are back in vogue.
Yes. Moving on quickly. I did want to ask, I had a question. You mentioned, we've been talking about the bipartisanship in financial legislation. I don't think TARP was an example of bipartisanship in a good sense of how legislation should be done. The problem was not over-partisanship, but it was not a model for good policymaking. In fact, maybe a better model would be Gramm-Leach-Bliley, where most of the hard work, I understand, what was done administratively. And by the time the bill passed, it was almost a non-issue because the regulators actually did their job and rolled back the rules that were not needed when it was incumbent on that, or anyone else on the panel.
So I used to work at a thing called the Bipartisan Policy Center, where my view, and now I'm at Brookings. Actually, look, I agree with your thesis. Bipartisan doesn't mean right policy. There are plenty of mistakes that are bipartisan, and there are plenty of times in which the two parties reaching an agreement means politics triumphed over good policy. So, just because something's bipartisan doesn't mean it's right. I would agree with that. I think you have to examine each thing individually on the merits. And that's something important to keep. On the other hand, I do think it's worth noting that this looks like it's going to have more of a bipartisan consensus than any other legislation since TARP.
Let me throw this out there after on this point. This is going to happen. I mean, something is very, very likely something's going to pass, and it is going to be bipartisan. But as far as what we know right now, does anybody think that there's anything terrible in this bill? Okay.
Well, I view this as kind of the Goldilocks bill. It's not too far helping Wall Street. It's not, nothing. It's doing some major reforms, and it attracts bipartisan support in the Senate, which if anyone who's watched the Senate this Congress, there's not 60 votes for a lot of things in this Senate. So this is a bill that supports our communities, and it's going to attract enough bipartisan votes to get to the president and signed into law. And as I mentioned at the beginning, this is kind of the first bipartisan test case of what could be done on Dodd-Frank. I mean, if this doesn't pass, there's not going to be an appetite to bring up any of these good reforms going forward. It's just going to be tabled, and it'll be a long time before we get to any other banking relief. If this passes, I think it'll create a environment of goodwill, bipartisan goodwill, that other things that have been brought up at this conference to be addressed in a bipartisan way as well. A lot of banking regulations are attracting bipartisan attention of what can be fixed or altered. So this is really the first important bipartisan test case on financial reform.
Aaron, what is your terrible piece?
I mean, I listed my top three problems. And, you know,
I have mine too, but
yeah,
I mean, a terrible on a scale of 1 to 10, 10 being atrocious. How terrible?
yeah, I mean,
are we
look,
talking?
look, if you come back in time and you say to me 30 years later, there's been a financial crisis, I can pinpoint the mistake to S2155, what was it? I would probably say 402. One.
For
right?
those not initiated
Sorry,
on the bill.
sorry. It's this custodial asset thing where the government would be providing favorable treatment to only 3 of 30 plus entities that do this, that would concentrate that activity. And their definition of that activity could include things supposedly super safe, as you point out, but by one definition, Greek debt would qualify. By other things we've seen it in the crisis, folks are able to use super safe one day becomes super risky at the moment of crisis, right? A crisis occurs because something that looked safe turned out not to be. A crisis never occurs because something everybody knew was risky turns out not to have worked out, right? 2 is I'm very concerned about, this idea that this is the first bite of the apple, that we're just going to keep gnawing away and gnawing away and gnawing away, and eventually you're going to hit the core. And that continues to concern me. It also concerns me that we're missing an opportunity to do things.
I don't awake at night worrying that Congress is going to deregulate too much.
Oh,
And this is the Heritage Foundation, for God's sakes.
Well, I mean, I worry about the regulators we have doing that, anyways, as you said.
Do we have any other questions, Paul? Or
I'll say a few words.
and then John.
I don't wait for Mike. Paul Kupiec, AEI. Reciprocal deposits. I'm not sure why they deserve favorable treatment. We have deposit insurance limits for a reason, and I'm not sure why CDARS deserves, all this extra benefit. The numbers will move. I suspect, 50 going to 50 to 100 is no big risk. 250, I don't really have a problem with. I think I testified 2.5 years ago. If you had to set it, I think I was the only guy that said it on the stand. If you had to set a number, I'd set 250. That would be it. So I'm pretty okay with that. The securities law things that David brings up, I think, sound very reasonable. It'd be nice if they got some of those things in there. I think it's a Goldilocks law, which I think gives it a good chance of something happening. So, more power to them doing their job, I think.
My whole thing on reciprocal is, I mean, I agree. My preference, my optimal would be not to do this. My thing is that if they're going to do it, it should be more limited than what's in there. That's my only thing. John?
Yes. John Burlaw, the Competitive Enterprise Institute. I'll phrase this in the form of a question, even though I believe I know the answer. But I had to ask something or ask or point out something as far as what Aaron said. The office of the comptroller of the currency, is that removable by the president? Because the distinction made by the courts was you either have cabinet officers where there's a single head that were removed, or you have a bipartisan commission removable for cause. This is very rare. You have a single director that can't be removed by the president. So can the office of the comptroller of currency be removed, and what's the standard for removal there?
So I'm an economist, not a lawyer. I know that the powers of the Bureau were modeled on the comptroller of the currency. I know the comptroller of the currency is part of the Treasury Department, although he or she functions in a historically independent manner. I've actually, one of my jobs when I was in the Treasury Department was to shepherd this executive order through. And one of the boxes, I had to look at all the different boxes in the Treasury Department. Bureau of Engraving and Printing, Comptroller of the Currency, all these different folks. So being a good bureaucrat, I call the Comptroller of the Currency and I say, listen, I got a box. I got to fill in this box. You're an independent agency. I'm not trying to exert any pressure from you from the Treasury Department. Here's the thing from the President of the United States. It's an executive order. Write in your box and give it back to me, and I'll pass it along. Okay. Call me back a couple weeks. They say, we've determined that the executive order of the president doesn't apply to us. I said, what do you mean? This is an executive order of the president of the United States. It applies to the executive branch of government. I'm an economist, but I was a child and I saw the 3 branches of government. and I don't believe you're part of the judiciary, and I know you're not part of the legislative because that's where I came from. They go, yes, well, we're independent. And I said, I don't really understand, but I'm a good bureaucrat. Just, can I write in the box? I have to write something in my box, right? I'm like a red stapler moment. Like, I can't have an empty box. They go, can I write, the Office of the Comptroller does not believe this executive order applies to himself? And they go, yes. I was like, okay, that's kind of weird, but like, that's what I'll write, right? My job is to fill the boxes. And I sent it on, and that was the last I heard. You know, the idea of having an independent entity within the Federal Reserve, which is also an independent entity, things are getting kind of weird here. Is there a fourth branch of government? I don't know. There's a broad court philosophical debate for all of that to decide. What we've had with the comptroller of the currency seems to have worked and been stable. What its basis is in constitutional law escapes my humble mind.
Actually, the statute I have in front of me says that he or she is removable by the president upon reasons to be communicated by him to the Senate. So you could just any basic reasons you can, but not even for cause. Whereas there's malfeasance or very high standards in the CFPB, so they know. I mean, even if it's not exercised, the president does have this power.
I think we have a lot of things in this country that may not have been written into the statute, but are kind of common conceptions that have made our system work more functionally. I think under this current administration, those common perceptions are being questioned to their core in ways in which the president has acted that are just different. I'm not trying to make a partisan position here. I'm just trying to say the president here has taken things that used to be taken for granted, like you have to release your taxes, and just turn those questions on their head. And I think our society will shake out one way or another for that.
The controller has not always been without controversy.
That's right.
It was a big deal. States' rights, there's now, kind of a brewing under the current between fintech and whether the controllers are going to, approve these kind of things. Or is it going to be, so it's not like it's been a totally
One thing I would jump in there and say Congress has to do their job of reviewing regulations as well. I think a lot of these independent agencies can get carried away in implementing regulations. For example, I mentioned earlier that Dodd-Frank put in a few new data reporting requirements, and the CFPB took it and went this far with it and put in all kinds of onerous new regulations. So Congress should come back, and you have the Congressional Review Act. There was a vote on mandatory arbitration where Congress reviewed a CFPB rule and said, well, no, we're throwing this out. It shouldn't apply this way. So Congress, I mean, you do have the different branches of government, and you shouldn't have wildly independent agencies of any kind, whether it's the FDIC or OCC or the Fed. Congress has to be part of that as a check and balance.
So I think Congress has been highly schizophrenic on this. So the OCC used to have to submit their congressional testimony through the Treasury review process, and then Congress, in making it more independent of Treasury, allowed an exemption of both Treasury and White House clearance. The Congress, every time they've created new regulators under Democrats or Republicans, whether it's the CFPB or the Federal Housing Finance Agency, an idea proposed and enacted with lots of Republican authorship and signed by President Bush, single agency head. Took an old board, the Federal Housing Finance Board, and an old structurally weaker regulator, OFEO, and merged them, single agency head. So Congress keeps creating agencies with single agency heads, and then has a really difficult time confirming anybody for that job because they view that job as being so powerful, and maybe there should be a board or commission, et cetera. And then they create a new regulator like the Office of Financial Research, single agency head. So it's been a very bizarre process. And this isn't just picking one bill or topic. You now have a trend, right? 3 new regulators make a trend, all 3 of which have had single agency heads.
And my understanding is it's legally problematic. I'm not a lawyer either. Either way, I am 100% certain that's not going to be addressed in this bill. If we don't have any more questions, then we can wrap it up, I think. Thank you guys very much for coming. We appreciate it.